In today's video, we will share why we are interested in REIT investing if you are keen to retire with a mindset of passive income and how to let your money work for you. This video is made especially for you. Before we dive in, here is a quick disclaimer. The information in this video is for educational purposes only. It is not a call to buy or sell. Hello everyone. Welcome back to the STA Club. The club is for stock trading and analysis. This channel is dedicated to providing you with high quality tutorials, guides, and insights that demystify the world of trading. Join us as we will share more trading secrets and valuable insights. To stay updated and be the first to access these valuable resources, hit that subscribe button now. By subscribing, you're opening the door to a world of trading and maximizing potential for your success. In today's episode, we will share our take on the US REIT market. Is this a good time to buy the US REITs? Strap in because we are going to break down the mechanics of REIT market outlook in 2024 and how REITs can help you generate passive income. Let's look at the US core CPI thus far. And we all know that the tail end of the rate hikes is already here. And the next step for the Feds will be to lower the interest rates. Now, how will interest rates affect the REIT business? REITs make money from rental income, and a major part of their costs come from interest expense, because REITs also borrow money from banks too, as they will need the funds to either make a new property acquisition or to do asset enhancements by renovating an old property. Therefore, the lower the interest rates, the better the net interest income. So, with the Feds lowering the interest rates, then this would mean that REIT investors will benefit from the eventual cheaper interest costs on any new repriced loans. Here, you will find an actual case scenario of how REIT returns perform relative to the Fed rate cuts and hikes. You will see that when the Feds began to hike their interest rates in 1999 to 2000, which was near the peak of the dot-com bubble, US REIT returns, the blue line, fell slightly, while US stocks, the black line, increased. But notice that as the Fed came towards the tail end of the interest rate hikes in June of 2000 to February 2001, they began lowering interest rates. We see that US REIT returns reversed upwards, while stocks then began to decline. This contrarian move between US REITs and US stocks continued all the way to 2003. So what does this chart tell us? It seems that from here, US REITs may also be a good hedge against an overall US market downturn. Coming back to my earlier point, where we feel that the Feds have now reached its tail end of the rate hikes and their next step will be to lower interest rates. Will we see the same thing happening, where returns on the US REITs will continue to climb while return on US stocks pair their recent gains? As we look at data from the year 2000 to 2023, you will find that US REITs enjoy lower earnings volatility as compared to US stocks. This makes REIT earning growth slightly more predictable than US stocks, and perhaps this is probably why US REIT returns tend to be more defensive during market downturns. As at 2023, you will find that US REITs valuation multiples have come down and is now below its long-term fair value range. But since its bottoming in 2023, we see that the valuation multiples have started to climb up slightly. Does this tell us that US REIT investors are already anticipating the rate cut and are already pricing in the anticipation, similar to that of the 1999 to 2000 dot-com situation shared earlier in my video? In conclusion, I think we as long-term investors, whatever stage of life we are in now, we should consider putting at least a meaningful portion of our portfolio into REITs due to their defensive nature relative to stocks. Remember, to build a meaningful portfolio with a long-term horizon, it is time in the market that is very important. Treat your investment portfolio like a regular savings account. Set aside a reasonable sum of money to invest, say maybe monthly, and let the power of compounding do the work for you. The more allocated capital you have in REITs over time, the higher your distribution payouts. And if these payouts are reinvested every time you receive them, then you will see the power of compounding take effect over time. I have seen an investor generate a yearly distribution payout of $200,000 per year just from REIT investing at the age of 50. This is $16,000 a month in passive income. With such a decent amount of passive income, does it still really need to work? Maybe not. Of course, to reach such a huge distribution payout does not come easy. You will need discipline in money management. You have to start investing young so that you have more time in the market to compound your money. But what do we look out for? While there are so many REITs in the market, are all REITs really that safe to invest in? In our next video, we will bring you part 2 of our REIT series, where we give you useful hacks that we use to identify good REITs. If you find this video interesting and you felt that you have learned something, do remember to subscribe. So stay tuned and see you in my next video. Goodbye.